Are you losing tax-free money? If you're saving for a first home in the Stony, Spruce Grove and Greater Edmonton area, do you know about the FHSA and the RRSP Home Buyers Plan? And more importantly, how they can work together? If not, you could be leaving up to $100,000 of tax advantage down payment money on the table. I'm Zelinski, and because I'm licensed in both real estate and mortgage financing, in this video, I'll walk you through exactly how this works. Also, if you'd like a personal consultation on how these are set up and how it can work towards your upcoming home purchase, message me directly and let's get you saving tax-free. Now let's dive into these things. First, this is one of the most searched topics by first-time home buyers right now today. And most of what's out there is very generic and national in content. So today I'm going to cover 4 key things. 1, what is the FHSA? Number 2, what the RRSP Home Buyers Plan actually is. Number 3, how you can combine the two for a much bigger down payment. And number 4, the pros and cons of each, so you know which order to use them in and take the most advantage. By the end of this video, you'll know exactly how to use these accounts for your home purchase. So let's start with what is the FHSA? The FHSA is the First Home Savings Account. This was launched in 2023 and is generally one of the best tools the federal government has ever really given to first-time home buyers. Here's why. It combines the best features of an RRSP with the best feature of a TFSA into one account. TFSA being a tax-free savings account. Like an RRSP, your contributions are tax deductible. You contribute, you get a deduction on your tax return. Like a TFSA, when you withdraw the money from a qualifying first home purchase, that withdrawal is completely tax-free. You can contribute up to $8,000 per year with a $40,000 lifetime maximum. Used room carries forward, but only 1 year at a time. It's capped at an extra $8,000. So the most you can ever contribute in a single year is $16,000. There is no repayment requirement. Once it's out for a qualifying home purchase, it's yours. That's the single biggest advantage over the home buyer's plan, which we'll tackle and get into next. To qualify, you need to be a Canadian resident, at least 18 years of age, and you haven't owned a home that you've lived in as your principal residence in the current calendar year or in any of the 4 preceding calendar years. Important to know for couples. Even if your spouse already owns a home, you may still qualify individually if you personally meet that 4-year rule. And that's worth a conversation with me directly because it trips up a lot of people. And you have the advantage to take advantage of that kind of money available. So let's look at what is the RRSP Home Buyers Plan. The Home Buyers Plan, or HBP, has been around a lot longer and it works differently. Instead of a tax-free withdrawal with no strings attached, the HBP lets you withdraw up to $60,000 from your existing RRSP tax-free. And that goes specifically to buy your first home. But here's the catch. You have to pay it back. You have 15 years to repay the full amount back into the RRSP. The repayment starts the 2nd calendar year after you withdraw. So, for example, if you withdrew the money in 2026, your first repayment is due in 2028. Each year, you're required to repay 1/15 of that amount. So the way that breaks down is on a $60,000 withdrawal, that's $4,000 a year. If you miss a year's repayment, that missed amount gets added to your taxable income for that year. It doesn't just roll forward. Your RRSP contributions need to be in the account at least 90 days before you withdraw it under that HBP program, or it won't qualify. Think of the HBP as an interest-free loan from your future. It's powerful, but it's not free money the way the FHSA is. You owe it back to your own retirement account at some point in time, so you're borrowing money from yourself. So we're going to look at now, how are you using them together and most effectively? Here's the best part, or really the magic, that not everyone is really familiar with. You are allowed to use the FHSA and the HBP together on the same home in the same transaction. The maximum FHSA is $40,000 per person in the lifetime. The maximum HBP is $60,000 per person. So combine that, that's up to $100,000 per individual toward your first home. So for a couple buying together where both partners qualify, you're looking up to $200,000 combined. So for a Spruce Grove, Stony Plain starter home, that kind of down payment you can access can really make a difference between needing a mortgage default insurance going in at 5% down versus 20% down, which really does change your monthly payment, your insurance premium, in some cases, really the interest rate for you as well too. This is exactly where having a dual licensed advisor really matters, because I can show you how that down payment size actually plays out in your mortgage numbers, not just in theory. So we can really set out a budget and make a plan that is best for you around those numbers. So what are the pros and cons, and which order do we actually use these in? So let's break this down side by side. FHSA pros. They're tax deductible, going in tax-free, coming out. It's the only Canadian account that does both. No repayment required ever. If you don't end up buying, it rolls into your RRSP with no loss of contribution room. And you can hold investments inside it, so your down payment can actually grow. FHSA cons, the downside, the annual limit is only $8,000 per year, which means it takes time to build up. If you're starting from zero, you also have to open the account before the room starts accumulating. So there's no retroactive room for years you were eligible and hadn't actually opened one yet. RRSP HBP pros. So higher single withdrawal amount at $60,000. If you already have an RSP savings sitting there, you can access it immediately. No new account needed. And it can be used more than once in a lifetime if you fully repay it and meet the first-time home buyer rules once again. The RRSP con is that it is a loan against your own retirement. It's not free money. Missed repayments become taxable income, and pulling a large amount from a smaller RRSP can seriously slow your long-term retirement growth. My general advice, and this isn't financial advice for your specific situation, make sure you always confirm with your accountant or financial planner. But basically, it's to maximize the FHSA first, since it never needs to be repaid, and use the HBP to top up whatever additional down payment you need. That order minimizes what you owe back to yourself down the road. So that's the FHSA and the RRSP Home Buyers Plan explained specifically for first-time buyers if you're looking in Stony Plain, Spruce Grove, and West Edmonton. If you're not sure how much room you actually have in either account or how this would change what you actually qualify for on a mortgage, that's exactly the kind of question I can help you with and I deal with every day. Being licensed on both sides of this, as a real estate agent and as a mortgage broker, I can be there to guide you through that process. Drop a comment with your biggest question about the FHSA or the HBP. Hit subscribe if this was helpful to you as well. And reach out directly if you want to map out your very own numbers. I'm Murray Zelinski with the Zelinski Realty Group, and I'm here to simplify that real estate and mortgage process for you, one video at a time. Cheers.